Has it ever happened to you that right before the price reached the order block you had marked, it made a sharp move, hit your stop loss, and then continued in the same direction as your analysis? This is exactly where most traders say, the market hit my stop. But the truth is, the market isn't against you. It's just following its own path to collect liquidity. In this video, through 5 sections, you'll learn exactly what liquidity really means, why it forms before every major market move, and how you can use it to make your entries far more precise. And in the final section, we'll reveal a key point that will help you spot much stronger setups in the market, the kind that only smart money traders can truly identify. Section 1. Definition of liquidity. Now, let's take a closer look at what liquidity actually means. In the smart money concept style, liquidity refers to areas where a large number of orders are concentrated, the same places where most traders have placed their stop losses. For banks and major institutions, a market without liquidity is a market they can't even enter, because their trading volume is extremely high and they need an opposite side of orders to execute their positions. That's why, before they enter the market, they create conditions for stops to be collected. In other words, they push the price up or down to generate the necessary liquidity. For example, market makers, by forming this triangle pattern, created liquidity both above and below the triangle. With this downward and upward move, they swept the liquidity on both sides of the pattern. In a way, they were fueling the next downward move. Section 2. Double top and double bottom. Now let's move on to a very well-known example, double top and double bottom. When two highs are almost on the same level, we call it a double top. And when two lows are on the same level, it becomes a double bottom. Classical traders usually consider these zones as strong reversal areas. But for smart money, these zones mean something completely different. That's exactly where the stop losses of traders are gathered. Above a double top or below a double bottom, there's always liquidity. Why? Because thousands of traders have entered trades around that same level due to the formation of the double top or double bottom, and their stop losses are almost all placed in that area. And that means there's a huge pool of liquidity available for the banks. Section 3. Trendline Liquidity. Now, let's look at another scenario. Imagine instead of two highs or lows, we have several consecutive highs or lows. They might be horizontal or repeating with a certain slope. In this case, it's no longer called a double. It's called trendline liquidity. Each time the price bounces from that area, traders say, this trend line works perfectly. Next time, they enter again at the same place, with their stop loss placed exactly behind the trend line. That means every time the price reacts to the trend line, more liquidity is being collected. And when that line finally breaks, that's exactly when the banks step in, hit everyone's stops, and collect all the liquidity. Remember, the market is always drawn to liquidity like a magnet. Wherever there's more liquidity, the probability of price reaching that point is higher. Section 4. The difference between liquidity and sweep. Now, an important point. You need to clearly understand the difference between liquidity and sweep. As long as, for example, you have two highs and the price hasn't yet moved above them, there is liquidity in that area. But if the right high goes slightly above the left high, takes out the liquidity, and then returns downward, there's no longer liquidity left behind, and this event is called a sweep. The same logic applies exactly to trendline liquidity as well. As long as the price is only reacting to that trend line and none of the highs or lows on that line have been broken, it means the liquidity is still there. It's still the fuel behind that trend line. But the moment the price breaks those highs or lows along the trend line, it means it has come to sweep that liquidity. From that moment on, that liquidity is gone. It has been used up. And usually, this is exactly the point where the market, after sweeping liquidity, starts moving in its main direction. So, based on this logic, this situation would be a sweep, and the other one would be liquidity. And with this drop, the price swept through these liquidity zones, then retraced and created liquidity again. Afterward, it mitigated our order block, reversed, swept these liquidity zones once more, and continued its movement. Section 5. The relationship between liquidity and order block. One of the most important points in smart money concepts is that the closer the liquidity is to the order block, the stronger the setup becomes. That's because this liquidity is actually the fuel for the move. Price uses it to push itself toward the order block. And usually, that's exactly where the best entry point forms. Remember, liquidity is always the fuel of movement. So when you see price collecting liquidity and moving closer to an order block, it means you should start getting ready for an entry. In this example as well, after the price sweeps this liquidity, the only thing standing in its path is the order block, and upon reaching it, we take our entry in this manner. So far we've learned that liquidity means the area where stop losses are gathered. Double top and double bottom create horizontal liquidity. Multiple highs or lows form trendline liquidity. A sweep means the liquidity has been used up. And when liquidity is close to an order block, the setup becomes stronger. If this video was helpful for you and made your understanding of liquidity clearer, make sure to hit the like button so this content can reach more traders. Also, share your experience of practicing these same concepts in the comments below. As always, thanks for staying with me until the end of the video. Backtest with focus. And until the next video, stay successful.